Welcome everyone. Welcome to today's webinar. My name is Connor Spencer, and today with Tim Quinn, we're going to be discussing how trusts can maximize your tax benefits and asset protection. Before anyone does beat me to it, we will be sharing the slides and recording with you guys later today. I'll actually include the link in the chat shortly to our YouTube page. But in the email follow-up as well, provide the slides and some additional content around today's topic. But for those of you who are new to Lawpath, this figure needs to be updated. But if you're new to Lawpath, we are an Australian-based online digital legal accounting and tax advice platform. We've hit a milestone. We've been operating for over 10 years now, and we've helped over 500,000 businesses, small to medium, in different capacities within that time frame. We're very much tailor-made for startups who essentially need the service to fill in their gaps in legal and accounting knowledge. But we also, work with clients who are requesting that 6 to 12-month audit of the business, whether that's around their structure, their existing contracts, advice around intellectual property, and other things, just checking that they are compliant with changes in legislation, most notably employment and contractor law recently, and upcoming changes in privacy law. We also help clients who are about to go through rounds of investing, clients who are selling or buying businesses, and of course, clients who need expert accounting and tax advice, or just need their taxes sorted by our senior chartered accountants. So we're very much a one-stop shop for all businesses in multiple different industries. So you're not too small for us. You're not basically too small for ensuring you have a strong legal and accounting foundation for your business. Myself, I've got clients who has a camel milk business in WA. There's a woman I work with who works at the university in Darwin, also the Australian Navy in Darwin, has her own business there. And lots of people with cafes, trades, consultancy businesses, software development, e-com store, etc., etc. So those are just a few of the many 500,000 businesses we've helped in the past decade. And today, I think it's the next slide. Oh, we'll go to today's agenda first. So in terms of what Tim specifically will be covering, types of trusts, advantages and disadvantages of running your business through a trust, some tax considerations, and of course, how Lawpath can help. And not just in terms of our online tools, but we are also rounding out the end of the month and the end of this quarter with a final chance to get the 30% off on our annual tax plan. So more on that later. As well as a Q&A from Tim. So if you guys do have questions based on the content or maybe something else we haven't covered that's maybe specific to your business, do pop your questions into that Q&A chat. Should be the bottom right side, as we'll answer those at the end. In terms of additional information, if I do put it in the general chat now for you all to see. That's that. If you guys do want more information on Lawpath and on myself and Tim, I've included in there, that's the YouTube link where you can view this webinar later today. A link there for our internal legal team. Some of the hot topics we cover on the legal and accounting front, and then I've got Tim's LinkedIn and myself there as well, if you do want to chase up with us for anything specific to your business. And of course, we're joined today by Tim Quinn. I don't know if you want to introduce yourself, Tim, and a bit about your background.
I prefer hearing you say it, Connor.
Yeah, you like to hear me blow smoke up. So yeah, today we're joined by Tim. He's a qualified chartered accountant. He's got 17 years of professional experience in tax and business advisory at all stages of the business cycle, from startup to exit. He's got extensive experience supporting entrepreneurial clients meet their tax obligations and advising them on making the tax system work best for them and their business. And he's run tax divisions at director's level. So needless to say, he is extremely qualified. So if you are behind on any of your existing tax or BAS lodgements, more than happy to help you with those, and also ensuring you're on time for future ones. Tim and his team will be your go-to for there. Yeah, and I think that's enough from me. I'll hand things over to you, Tim.
Thank you very much for the very kind introduction that we haven't rehearsed 15 times. It's always lovely to hear my experience spoken about so glowingly. Thank you, everyone, for joining us on what is a rare, miserable Sydney day. It only happens once in a blue moon. Um, Always right when you've just hung the washing out. Perfect time for those of you in Sydney to pull up the computer and learn about trusts. Now, I've got a treat for you today. I think any old punter can become a lawyer, but it takes a rare breed of professional to become a tax accountant. So I'm going to give the game away. I'm going to focus a bit on tax today, more than the legal side of things. We'll run through the legals pretty quickly. I'm going to give you some practical examples of how trusts can work for SMEs. Anyone that is a follower of the news and the Murdoch family will know that there's a trust in the courts over in some flyover state at the moment, or it's in Nevada, isn't it? Uh, Not just the Murdochs use trusts. This sort of trust structure with the trust at the top and a holding company and an operating company is accessible. Small businesses in Australia are using this all the time. It is not a difficult structure to put in place. It is not controversial. This is not dark arts. We're not talking about double Irish Dutch sandwiches or anything crazy. This is accepted law. So it's a really, really common structure, and I'm going to talk you through a little bit about it. First of all, what is a trust? A trust isn't really a thing. It's not a legal entity. Unlike a company or an individual, which I guess in a way is a thing, a trust is really an arrangement. A trust is a series of legal relationships, ultimately between legal owner and beneficial owner. Now, how's that come to be? Hundreds and hundreds and hundreds of years of history. Why does it still exist? Connor knows the answer because 2/3 of federal parliamentarians have a trust structure. It is incredibly, incredibly beneficial to people from with a whole gamut of family wealth. It is a very, very sensible way of doing things. What governs this relationship? It's the trust deed. The trust deed, think of it as similar to a company constitution. It's the rules of how the trustee will act and how the beneficiaries will act as well. In terms of the structure, you'll often use a trust in combination with a company. Don't think of it as replacing one. Think of it really as a way of ultimately dividing out the benefits of running a company. So at its most basic, the trustee, the legal person, which can be a company as well, will legally own particular property, particular assets, but it only owns them with a very, very strict requirement that it owns it for the benefit of others, the beneficiaries. So a trustee will be the legal owner, say, of a property. They'll be the ones down on the deeds, but they will not own it for their own benefit. They'll own it for the benefit of a class of people. And the trustee has full legal control and responsibility. That's very important. These nothing, you don't get nothing for free. So there's always some responsibilities that come with these structures. We go on, Connor. Who are these parties? The settlor and the appointer, you basically hear of once and never really deal with them again if everything's going well. The settlor places the property into trust. The appointer has the ability to change the trustee, but most of what we do on a day-to-day basis is between that trustee and the beneficiary that we just spoke about. And we'll just rush through that because we've already covered it. What are these duties that we talked about? There's a few of them. The key one is the fiduciary obligation of undivided loyalty. This means that you as the trustee do not serve two masters. Now I can already anticipate the questions coming through. What if you are the trustee and the beneficiary? Typically you won't be. Typically, for a very, very good reason, which we'll get to later, we will have a company as the trustee and we'll have individuals and perhaps different companies as beneficiaries. For asset protection reasons, this is very important, but it also makes it clear that you can have no undivided loyalty because typically the trustee is not allowed to benefit as a beneficiary. So it's a very clever way of doing that. The trustee must only act in the best interest of the beneficiaries. They cannot act for themselves. They cannot profit. Now, they can be recompensated, but they cannot profit. They can't delegate their duties to someone else. It is their duty alone. You can't have a conflict of interest, and you must act in good faith. The remedies are what you expect, and they're very, very wide. In the equity courts, a court can basically require a trustee to do pretty much anything. to fix up a mistake. Thank you, Connor. Let's give you a really, really basic example, but basic can still work very, very effectively. What we've got up the top here is your ABC Pty Limited or Proprietary Limited. That is the trustee company. So you'll notice there that Anthony set the thing up. He's probably a lawyer or an accountant himself, potentially. Robert is the guy, is the brains behind the trustee. Robert is also, funnily enough, with his children, one of the beneficiaries. So the trustee is that legal holder of particular assets. The beneficiaries to the Joe's Fruits Trust are the ones that will actually get, funnily enough, the fruits of the labor. So even though we have a legal owner over here, that legal owner will never benefit from this trust. In this case, the people that will actually benefit from the Joe's Fruits Trust, or the XYZ Trust as it's known, are Robert and his children, hopefully adult children, which we'll come to later. Globex Proprietary Limited, which is called a corporate beneficiary, which again we'll come to later. So many teasing statements here today. And potentially even a charity can be named as a class of beneficiary. Thank you, Connor. Let's go through a few of the types. There are many, but I'd say 95% of them fall into one of these two buckets. At its most simple, a discretionary trust does what it says on the tin. The trustee will have the discretion to do with the profits, with the assets, with the capital of the trust, pretty much anything as long as it's for the benefit of the trustees. Pardon me, benefit of the beneficiaries. Got to be careful the way you talk about these things. There is basically no limit to their discretion as long as it's within the trust deed. The beneficiaries don't get to control what the trustee does. The trustee can do whatever they like. Now, as you well might imagine, this can come up with problems down the line. I believe there's probably a Gina Reinhardt trust or two that's had a bit of discretion gone awry. When the trustee has the absolute discretion to do what they want between a class of beneficiaries, some beneficiaries can be more favored than others, and it's completely legitimate. But that itself gives us a lot of tax benefits. So again, you don't get one without the other. There's always the trade-off. The unit trust is more straightforward, I think, and typically less seen. The unit trust is very much quite similar to a company in that you will own a particular number of units. That number of units will entitle you to a fixed proportion of the capital and or the income of a trust. We typically don't see that for small businesses. We typically see that for more investment purposes. So, and again, sometimes you'll see a unit trust with a discretionary trust. The unit trust itself, not particularly tax effective. It's kind of tax neutral, but it's a nice, easy way of organizing things. We move on.
I suppose on that, Tim, you
Yes.
might actually cover it later on, but do you have a favorite out of these two different structures? Is it very dependent on the short term, or would you even caution someone to go one route if they have longer term goals, like looking at the investment one in particular?
I would say that any tax accountant who thinks of themselves as an advocate for their clients would be recommending discretionary trusts. Both are incredibly effective asset protection vehicles. The discretionary trust has far more flavorful tax implications that are more enjoyable. So there are occasions when you'd use a unit trust. For SMEs, small businesses, typically a discretionary trust will be more common.
Okay, thank you.
Question. All right. Like I said, you don't get something for nothing all the time. And I can see someone's asked a question. We might get to that just after this one. The key advantage of a trust, almost probably why it came into existence all those hundreds of years ago, is asset protection. It's basically putting yourself to an extent with beyond the arm of people that would come after these assets. If you imagine a very simple scenario where there's a trust that holds particular assets, and that trust has, for instance, a corporate trustee, if I am sued in my own name for something, those assets held by my trust, which I might also benefit from, are very difficult to touch. So when we talk about asset protection, anytime you're separating legal from beneficial ownership, you are putting assets that you benefit from a little bit beyond the arms of people that would come after them. And there's been lots and lots of different cases and lots of different media publicity about that as well. So it's very, very common. It's not always effective, but it's pretty close. A well-designed trust deed written by a good lawyer, such as the ones that we provide through Lawpath, are very, very effective at shielding you from creditors. Tax minimization, I'd like to put it number one. There's a reason we don't. And if anyone can answer it later, I'll throw you a cookie. But tax minimization is incredibly, incredibly important when we come to trusts. It is this way of having this discretion. So when we're talking about these, we are talking discretionary trusts. That ability for you to put on your trustee hat or director of a trustee hat and say, I'm going to decide how the potential beneficiaries receive this money, receive this income of the trust, rather than it all going into my personal tax bracket. I might be doing very well for myself on $250,000 and I would lose 47% to the tax office. Instead of doing that, I might have some people that I know and am very familiarly close to who can absorb some of that and pay a little bit less tax. So that's a very key one. Flexibility is sort of similar to that. There are reasons why you might want to assist. For instance, someone I had come through yesterday that wants to provide for their adult parents into their retirement. Having a trust and a discretionary trust with the flexibility to distribute income to them is a very nice way of doing it. And there's also succession planning, funnily enough, as we've talked about the Murdochs a couple of times. These trusts are often used to pass on assets to the next generation, particularly where there are multiple inheritors, multiple successors. So it can be done very well. Thank you. And we might maybe touch on a couple of these questions just before I go through the disadvantages as well. We'll start with we'll start with Adam's because I can see his more clearly. Adam asks, on a class of beneficiary, do you need to have a primary class? Also, can you have a class of beneficiaries that is determined by membership outside of the trust? Oh, member of a specific group. I've got to say, I haven't ever come across that, Adam. I've really almost primarily come across family trusts in terms of a common structure. You certainly can set up trusts for most reasons. I typically say if you can describe it in a trust deed, it's probably going to be okay, unless it's for an illegal purpose. I would say that membership of a specific group, I would say you probably could. That sounds fine. Do you need to have a primary class? It's always good to have it's good to have fail-safe options. So if you have a primary class and then perhaps some of the other classes will fail, I think it's pretty common that you will have a primary class. So I'm not sure if it's 100% required. And then the other question was, is it possible to somehow set up a discretionary trust which can be controlled equally by two different families? Yes, it's not only well, I'd say it's reasonably common actually to have typically perhaps one discretionary trust, one corporate trustee with two directors, and those two directors may be different families. There's nothing that requires that those two directors are related. Now, when I say I have seen it come up, I've typically seen it come up because it has failed. So often, startups, for instance, will think, fantastic, this is the best thing since sliced bread. My business partner is wonderful. We are going to make $1 billion. And perhaps they've gone in without proper advice and set up this structure with one discretionary trust and two very separate corporate trustee groups. You typically see it when it fails because you can imagine there's a gridlock that can be caused if one party wants to go one way, one party another. And if there's no tiebreaker mechanism, it typically will require the courts to step in and resolve it, typically to dissolve it. Thank you. We might move on. A hybrid trust. When I said 95% of trusts, I knew that would open up the question. Yes, there are hybrid trusts. There are special trusts. Again, because a trust isn't a legal entity, when you sign up for one, there's nothing that says in a nice, neat little bubble, you are a discretionary trust or you are a fixed trust. A hybrid trust has characteristics of both. Why do you see them? Typically for more complex mergers and acquisitions, typically more complex transactions, there may be a need to separate to have some elements, perhaps a fixed component to capital. So perhaps if everyone's put in a certain amount into a trust, they are allowed to have the fixed entitlement to that to come back. But perhaps there's a degree of discretion how the income or perhaps how the voting rights are shared within that trust. So a hybrid trust is anything that is not clearly defined between the two. There'll be elements of discretion and elements of fixed. Disadvantages. Thank you, Connor. If we skip ahead, there are setup costs. There's no way around it. Yeah, anytime you get a quality accountant or a quality lawyer involved, there are, of course, professional fees to set it up. It's very much the case of, like with those will kits that you see, and you can buy them from the newsagents from $25. You probably can do it yourself, setting up a trust. I would advise very strongly against it. I would say your money is very, very well spent if you get it set up properly in the first place. Skipping ahead to 3, there are ongoing costs. There's no way around it. Anytime you're seeing the requirement to lodge a tax return or the requirement to actually enact that physical split, that distribution of the income at year end, it's going to require a professional to do it. Again, strongly advise you to get professional help. It adds a degree of complexity. There are certain small business operators that don't want to do it because they don't understand it, and I completely sympathize. I think there are occasions and there's a scale at which the benefits of a family trust are perhaps not worth the additional complexity. I'd say it's quite a low threshold where it can be tax effective, but if a trust is going to confuse you and keep you up at night and fill you full of worry, first of all, do talk to an accountant and let them try and assuage you of your fears. But yes, they are complex. There's no way around it. And then the final point there is that it can be a bit harder to borrow against. So typically, if you own some shares in your own name, you can borrow against them, or property in your own name. Banks will understand that. Mortgage brokers will understand that. Trusts, they get, but will take a little bit more working through, and they might discount the value of what they'll let you borrow against because it's held through a trust structure.
I suppose with the common mistakes business owners make when they're setting up their trust structure, is it pretty much, I guess, not doing the admin right, or maybe not even registering for GST? But is there any others that can kind of cop them out the advantages of the trust as well?
No, look, funnily enough, the GST one, most trusts actually won't need to register for GST. It's typically if you've tried to go it alone and you just haven't filled out the documentation. None of it's necessarily fatal, but it can. You imagine if you haven't touched your trust for a few years and perhaps there's been income and it's gone in and out, there's a bit of catch-up work to do. But it's as long as you've engaged the appropriate help, you will have someone there to hold your hand through it. So like someone's asked, can you send this presentation? Absolutely, of course we will, but don't feel like you need to remember it all now. These trusts are very, very common, and your competent accountant will be able to hold your hand through that process. Just while we're on that, we've got another couple of questions as well. Oh, how do we continue the trust when the trustee dies? It does happen. It's always anticipated in a well-worked trust deed what happens. Typically, the appointor can appoint a new trust deed in an individual structure with an individual trustee. There's often needs to be a deed of variation, so you'll need to get a lawyer involved to draft that. In a corporate trustee, it's typically simpler, and you can appoint to that corporate trustee a new director, and they will typically become a director of the corporate trustee, which stays the same. So it's a big tick in the pro column for a corporate trustee. Okay. Any benefits to consolidated from a tax perspective? Yeah, well, it's kind of a different question there, Adam. Tax consolidation, yes, there can be benefits. It's not really typically, I've almost never seen it done with trusts, just because of that separation. It's in order to tax consolidate, you need to have 100% ownership. It doesn't really make sense from a trust perspective, but in terms of a holding company and a subsidiary, yes, it can be a little bit cheaper to do your tax if you consolidate. Jerome has asked, are there any apps or online services that facilitate administrative requirements? Yes, Lawpath. Yeah, if you're coming to us from lawpath.com.au, we are very much an online an online marketplace and an online business for assisting small businesses and taxpayers with their tax requirements. And we will certainly facilitate and prompt all of your compliance requirements. We don't leave that up to the trustee. We know that most people need a helping hand, and that's what we're here to do. I would say we typically would handle 95% of a trust's actual compliance requirements rather than the individual needing to do a lot themselves. No worries, Jerome. Let's move on a little bit, Connor. All right, rather than just talking through all these, there are considerations. So again, I've already said, I recommend that you talk to a professional. I typically recommend that you talk to a lawyer and an accountant. They have different ways of looking at things and different focuses. Involving a lawyer, of course, will get you more covered from an asset protection perspective. They'll help you walk through change of trustees, classes of beneficiaries. They'll help you understand how trusts can come undone in their experience as well, and how to avoid that. From a tax side of things, often the lawyers won't think too far down the line. Accountants involved in trusts are thinking not just this year, but what happens in 5 years? Perhaps your family circumstances change. What happens in 20? Often, and we'll come to this in a short while, what about when your children go to university or finish high school? Well, guess what? They become very, very valuable from a tax planning perspective. So we really think far ahead in terms of tax, and that's our focus. Whereas the lawyers, of course, are concerned about liability, how it's formed, how it's run, and who's chosen to be beneficiaries or potential beneficiaries or classes of beneficiaries. Moving ahead, Connor. How can you set it up? Forget all of these steps because you won't remember them anyway. Just know that there are steps, and again, I cannot recommend strongly enough that you come to a proficient lawyer to set this up for you, because they will handle all of this for you. They will make sure that they have signed copies. They'll typically keep paper copies themselves or arrange for you to do so. They'll have everything signed. They'll handle all of this. But what is required? First of all, you've got to choose who your trustee is going to be. Is that going to be individuals? Is it going to be a company? Typically, we'd recommend a company. You've got to draft that trust deed. Like all very good, high-quality documents, it doesn't start from scratch. It starts from a boilerplate, from a template, for a very good reason, because those templates have been thrust in front of a judge many, many times, and we know what works and we know what doesn't. But of course, with that, no trust is the same, and there will be areas in that trust deed where a lawyer can advise on where to make some changes, and of course where not to make some changes. Have the trust settled by the set law. This is a legal process. It's a documentary process. It's best handled by someone who knows what they're doing. Stamp duty. Some states have it, some don't. Some call it transfer duty, some still call it stamps. You'll be much better placed if you are advised on this professionally. Getting an ABN and a TFN sounds simple, never quite works out as easily as you think, but it can be turned around in a couple of weeks. The ATO is sometimes good, sometimes not at doing that. Opening a bank account, if you've got all the documents in place, very, very simple. Of course, all of the big banks and most of the small ones know exactly what they need from a trust, and they'll be able to advise you. How do you close a discretionary trust? Sorry, Connor, I've just jumped onto some questions. I do like to deal with them as they come through, so it's all fresh in my mind. So Gail says, how do you close a discretionary trust? Again, typically the trust deed will have allowances for how to do this, but it often, it can be called vesting, it can be called a number of things. There might be conditions precedent that once you meet them, that trust almost becomes closed by default. But more commonly, there'll be another legal document executed, another deed to vest and wind up that discretionary trust. I do not recommend you ever trying to do it yourself. It's reasonably complicated. We've got Helen saying she has a company that runs a business and holds certificates. I don't know if that's going to be share certificates, something like that. If I need to set up a corporate trust, where should the company be positioned? Should it be an operating company under the trust? Typically, we'll see a trust at the top, trust being the ultimate owner, with beneficiaries shooting off from that. Underneath, you'll have a company structure. Often, like you've suggested, if one company inside of that has valuable assets, those assets will be separated from any company where there's potential liability. So potentially you might have one company that holds assets, you might have one company that does stuff, particularly in business. Helen, I do recommend you get advice on that because when companies hold shares, companies do not have access to the capital gains tax discount. So typically we like to move anything where we think that the value might shoot up in the future, we like to hold them within a trust rather than in a company. And they're coming in thick and fast. I have a client who's having a family trust, applying for a TFN, and perhaps one of the share trading companies both ask for an ABN. Why do you need an ABN? Yeah, that's a very good point. There's those business obligations in terms of what carrying on an enterprise, which is the terminology used in the law, how they've been interpreted wildly differs between the ATO day to day and between companies that should know better as well. I would typically just bite the bullet and get an ABN. That's usually the easiest way to resolve those issues, particularly because they are free to apply for. So I would do it that way. It can be very difficult. Jenny, is it better to have an appointor? You do need to have an appointor. That's a compulsory part. Can I also include the trustee as one of the beneficiaries? I don't think there's a prohibition against it. I would typically not do that because of the reason of the whole point of a trust is separation from legal ownership and beneficial ownership. That's where all the benefits come from. So that's why typically we don't have the trustee as the beneficiary. There can also be some strange tax consequences of doing that. So that's why we'd advise against it. Would you recommend having the company acting as the appointor? It's a very good question. I don't know if, and I suspect the answer is no, that a company can actually be an appointor. I've only ever seen an individual being an appointor. Company can certainly be a trustee. The appointor, certainly compared to the trustee, doesn't have as many obligations on them. It's probably a lower risk venture. Okay. Now, I promise some practical tips. We often talk big picture about trusts are great for tax, and sometimes I'll be 2 weeks into a conversation with someone and they might sheepishly ask, well, how do they actually reduce tax? You haven't covered it off. Because trusts themselves are typically not taxable. If you're doing it right, your trust will not itself pay tax. Any discretionary trust, the entire purpose of it is to receive income from assets or from something else and distribute income. Any income that's left there is actually taxed quite prohibitively. So you always want to get rid of the income of a trust. So then how does it work? How does it become so tax effective? Why do 2/3 of these federal parliamentarians have this structure in place? It is this element of discretion that we've talked about. It's this separation of trustee hat to beneficiary hat that basically allows you, when you're the trustee, to decide who's going to get the tax consequences of that income. So every year in the run up to 30 June, you run your accounts, you see what you expect you'll have to distribute, and you basically plan your distributions accordingly, that you'll give some to one party, some to another, some to a third, and you will obviously aim to try and give as much as possible to people on low tax rates and as little as possible to people on high tax rates. Sounds simple. It's gotten more complicated. Don't worry, accountants are all over this. It's still very beneficial. The second point of this is that, particularly in the early years, it's this tax holiday idea. If you're just choosing to pay yourself a salary through your company or director's fees, whatever you'd like to call it, you'll typically have to withhold tax at the time it's paid. So if you imagine you get paid on the 15th of every month, you've given some of that to the ATO and it's out the door and you'll probably never see it again. This tax holiday idea, particularly in year one of receiving these profits and you're distributing it out, you won't be paying tax on that until the end of the next tax year, which can be 22 months away. So you'll pay it eventually. You're not dodging any tax, but you're going to get a bit of a holiday on it and perhaps put it to better use in the meantime. Good time to see a couple of questions. Michael said that we've got a company under our family trust. Can an additional company be put under the trust? Absolutely. You just form a new company and the shareholder becomes the trust. It's a very common structure where you'll have the trust, a holding company, or not, and lots of different operating companies if they're doing different things that you want to separate from each other. What's involved in the process? It's very much any way you'd choose to set up a company, which of course Lawpath does. I believe about 9% of all companies set up in Australia are set up through Lawpath. So we can set you up a company, and the shareholder just becomes the trustee as trustee for the family trust. Then we've got some questions. Can passive income from trusts be held by an asset? Can this passive income be redistributed before tax to companies under the trust? Yes, the distribution is before tax, and then the companies under the trust, what we call the corporate beneficiaries, will pay tax on that themselves. So there's no double taxation in that structure. And Adam, who's keeping me busy, is keeping me on my toes today. Another question. If the trustee company has no assets, can it be a special purpose company to pay the reduced ASIC fee? Good question. It's certainly with superannuation trusts, which is a whole nother kettle of fish. The trustee there is a special purpose company. I believe, and in fact, I'm reasonably sure that a general trustee of a discretionary trust is not a special purpose company that's entitled to those lower ASIC fees. I think it's just for superannuation trustees, but could be wrong. Thank you. And we'll have a look at this practical example. I don't look like that anymore, but I don't have children that are that old either. So I've just taken some artistic license. That isn't my wife. I didn't want to embarrass her. What we have here is a very simple example, but a very common example of how a small business will operate a family trust. And I'm going to give you the answer in terms of how much tax we save from this structure on the next slide. But while we've got this one up, Quinn Consulting, very, very standard consulting company. It's doing well for itself. It's making projected to make a profit of $200,000. Now, Quinn Consulting is owned because he came to Lawpath. The company came to Lawpath, got it set up properly. It's owned by the Quinn Family Trust. And the trustees there, I've misnamed. I meant to say Nicola and Tim. So the two trustees, probably through a trustee company, are myself and my wife. What we look at is the class of beneficiaries. We say, well, who's in the family group? We look at Nicola. Nicola's the CEO of Quinn Consulting. She already earns $200,000 a year. Now that's a point at which she's doing very well for herself and will already be paying a lot of tax. Myself, working dad, I've taken a bit of time off. I have a lower salary. I'm only earning $60,000. And we have two adult children, Joe and Lydia, one of whom is on a gap year and one of whom is at university and doing a little bit of bar work. So they've got much, much lower incomes. Now, I'm sure you all know the outcome of where this is going to be, but let me draw it out a little bit further. Connor, if we see the next slide. Option A, nice and simple. Let's draw the taxable income of this company right down. Pay the $200,000 profit to Nicola as a director's fee or a bonus or a salary, whatever you want to do. You pay $94,000 tax on this, which is 47%. Simple, easy, no complication, but a lot of tax to pay. Option B is here. We put on our trustee hat. We do a bit of smart stuff. The trustee sits down and looks at how much everyone's earning, decides to give $40,000 to the two adult kids, on which there's $8,000 tax payable between them, and whatever's left over, $120,000 to Tim, the working father. And there's $42K tax payable on this. You can see how this structure works for small businesses. That family is paying on that $200,000 profit, $50,000 of tax instead of $94,000. Now, we've almost halved the tax bill on this company profit because of a very simple, very easy to implement structure. We're saving $44,000 a year. Sure, we spent $4,000 to set up the structure. We might be spending a couple of $1,000s a year extra on our compliance costs. There's a tiny bit of extra complexity, but gee, isn't it worth it? I'd say most people would think that's a fairly good trade. This is an advanced topic. There's actually an option C, but it's something that we can get down the line. If you imagine, if you come to a good accountant and you've got the enviable position of every class of beneficiary already earning a lot of money, we can add an option C into the mix that says, perhaps in a few years' time, not all of you will be earning so much money. Perhaps if you're planning on a maternity or a paternity break, or a bit of just an extended break from work, we can park profits and pay the tax on it at a low rate now and distribute them into the future. So there's lots of great smart things that we can do as tax accountants when you have this flexibility. I keep coming back to that point. This discretion, this separation means that you can do a lot with it, and good accountants know how to do it.
That was going to kind of be my question, Tim. Like, is this just maybe the most common structure, or is it not
Yeah,
necessarily the most tax efficient way as well?
it
So, like,
is. I would say almost without doubt, it is the most effective structure for running a business in Australia. If you think of what a lot of people think of as being tax effective, which is easy, I'll have the holding company in Dubai or Liechtenstein or the Isle of Man. Typically, if you're an Australian resident, those structures are worthless. You actually will end up paying the tax yourself anyway. This structure works. If you're an Australian resident taxpayer, it works for pretty much everyone. As long as you can justify the extra compliance costs with the estimated savings, I almost think you'd be mad not to.
and what if they don't have adult children? What's the options for those people?
Yeah, that's when the corporate beneficiary often steps in. So basically setting up another company, not the trustee company, a new company where you'll do what we call profit parking. You'll pay that company a distribution. It will pay tax at the corporate tax rate, which is 25%. And until we're ready for one of the other adult beneficiaries to absorb it in a better way, we'll leave those profits parked. And then, like I said, perhaps someone takes a break from work, they're not receiving as much income in a particular year. That's when we get it out of that little bucket company or corporate beneficiary and declare it as a dividend that way. And we've just got a couple of questions from the floor again, Connor. Yes, absolutely. We will be providing the presentation. That's no problem at all. And then Stephen says, should the trust own a separate company or can the trust itself trade? Yes, trading trusts do exist. You do occasionally see them. Not as often anymore. I'd say typically I would use trusts as a holding vehicle and I use companies to actually itself trade. What are the pros and cons of that? I don't know. The Corporations Act is a simpler to interpret beast. I think it's kind of more understood. It's more common to see these PTY limiteds. It can be an extra complication, I think, when you sometimes see down the bottom of a website, the company is so-and-so ATF or as trustee for a particular trust. I think it just adds a bit of corporate understanding when you're operating a business through a company, and it's just as tax effective that way. So that's typically why you see it. Stephen, again, good question. All profits need to be distributed. Yes, they do, but you can distribute those profits to a company. So you're not leaving them in the trust. You're sweeping them out of the trust. You're giving them to that company. That company will pay tax on those profits at the company tax rate. So you're not doing anything shady there. Adam, again, capital distributions from a discretionary trust subject to CGT. Yes, yes. So the income of the trust flows through to the beneficiaries with the flavor that it came in at. So if the income of the trust is capital distributions, if there's been capital gains within the trust or received by the trust, it will go through as a capital distribution to the trustee, to the beneficiary, pardon me. So yes, there will be benefit to CGT. So if a discretionary trust uses funds from the settlor to buy shares, can it distribute? No, you can't avoid the triggering of CGT. Alas. A good follow-up question there as well. What about minor beneficiaries? Minor beneficiaries used to be fantastic. The minors themselves, of course, if you've got children, are wonderful. But from a tax perspective, they're useless now. You can only receive, I believe it's $416 before you start to get hit with prohibitive tax rates. So minor beneficiaries, when I suggested before that we love it when they turn 18 and become more useful, that's because that's when they're really useful to receive trust beneficiaries at a lower income tax rate. Carl's asked, can this distribution be made to adult children? Yes. Can you have it pay them forward to other beneficiaries, particularly the parents? You've touched on a very, very good question here, and it's a what we call Part 100A. Pardon me, Section 100A. It's not a new area of tax law, but it's one that's received a lot of recent attention. What used to happen is that you would just say $180,000 distributed to each adult child. You would then actually not give them the cash. You'd keep it yourself as the working parent. Now that has really raised the ire of the tax office. They have stamped down on that now. So we act with a little bit more care and discretion. We would always advise the trustee to physically pay the cash to the beneficiaries. It's a little bit different when you're dealing with your spouse, with working spouses. It's accepted by the ATO that in the course of running a family, it doesn't really matter who gets the cash. If you have adult children, we would recommend you actually transfer them the money or do what's called a reimbursement agreement. Particularly, you might be paying for their university fees or helping them out with rent or anything like that. You could reimburse them and not actually give them the physical cash from that distribution. So that's typically how you do that. Of course, the ATO has no ability to stop your adult children from handing you back money. But if they saw that as a contrivance, as basically an attempt to be a bit sneaky, and that they'd only receive the cash in order to then pay it back the same day, they can apply certainly 100A or Part 4A as well as a general anti-avoidance mechanism. So any good tax accountant will, of course, help you work through your options, but they'll never recommend that you do something so sneaky that you're going to get yourself into trouble. Connor, dealt with all
Awesome.
the questions. How can Lawpath help?
Indeed, indeed. If anyone did actually join in a bit later, Tim here is the head of our Lawpath Tax and Advisory. So hopefully after today's presentation, it's really instilled some confidence that your business is taxed or trust is taxed in safe hands. Some of you might have already invested in a business mentor to help you off the ground from like the operational and marketing standpoint. So it really pays as well when investing in a competent and knowledgeable accountant. They will do the same for you when it comes to your tax compliance and tax minimization. And I can see from the poll, like tax compliance actually listed as the number one issue for everyone on the webinar today when it comes to managing their finances. I suppose there'll be a few people on the webinar today who maybe already have a business or maybe looking to restructure their business. But I suppose for you, Tim, like for people maybe on their day zero, about to maybe start up a company, like why is it crucial to have a tax plan or accounting from day one, and what can go
Yeah,
wrong if?
absolutely. These structures that you put in place are never permanent. You've never taken a step, typically day zero, that's going to mean it's impossible to fix in the future, but it does get more expensive. If you set your structure up from day one, it's been the cheapest way to do it. There'll be no capital gains tax payable in that setting up of the structure. If down the line you've got a trading business that you own the shares in your own name and it's going very, very well, and you've thought, okay, great, I really wish this company was owned by my family trust instead of myself and perhaps my spouse. We can do that, but the reality is you can't just gift it. So the ATO or the people that set the tax legislation, the federal government, are very, very clever. And they've said, just because you've sold this business or gifted this business into your family trust for $1, it's not an arm's length transaction. This is a too friendly sort of transaction. We're going to transpose the market value. Now, you might imagine, just as a rule of thumb, if you've got a comfortably profitable trading company that's making $1 million a year clear profit every year, that company might be worth $3.5–4 million easy. Now, if you're going to sell that company to your family trust or get it into a family trust, you personally are going to pay a big capital gains tax bill on that transfer. So if you're looking back, wow, this $1 million company, I wish it had been in the family trust. If it's in the family trust from day one, fantastic. It's been tax effective from day one. If you're looking at it and doing it now, okay, great, it'll be tax effective into the future. But in the meantime, I've got a big whopping tax problem to deal with. So that's really the in terms of getting it sorted early on, Of course, it's helping you sleep better as well. I often find sometimes people get really excited about setting up a business. They might get started down the path of compliance and then lose a bit of interest because they're dealing with the complexities of running a business. Can be really, really hard. If you've let things slip, as is easy to happen for a couple of years, maybe you haven't lodged your BAS, you haven't lodged your tax return, your money's going in and out of your company bank account all the time. You got bills to pay. Well, guess what? The ATO don't care, and they are going to whop you with these. Firstly, a love letter, which is what I call them. It comes in nice big red banners at the top. If any failure to pay means we're gonna take you to the cleaners, and they can come after the directors of companies as well for not paying certain taxes. Get your compliance sorted early. Get someone else to worry about what you've got to do. Basically, someone else that's going to come kicking and screaming if you're not lodging your BAS. Get someone on your side. So that's really a big benefit of engaging early. Again, if you do have stuff that's a few years out of date, it's never too late. I know there was an accountant near, I think it was a Concord West train station, or you go past it on the train and in big font they've painted on the wall, it's never too late. I adhere to that. Better to not bury your head in your sand a moment too long, but do engage people. Once you've engaged the tax agent, if you've got stuff that's out of date, they can go to the ATO and fall on their sword on your behalf and say, look at this client, they've made amends, they've changed their ways, officer, they've really taken proactive steps to getting engaging. We can help you reducing fees, reducing penalties, and really just helping you put payment plans in place. So it's never too late. Please do get involved. Good time just to answer a couple of questions before we talk about how Lawpath can help. Ballpark costs for setting and running a trust with Lawpath. Connor, I might leave that one to you and have a bit of a rumination on it. It's look, there are fees in setting up the trust deed. There are a few associated costs, but we're certainly not talking. I mean, probably $3,000, perhaps a little bit less. A bit of a structure there is a fairly common sort of fee that we see. Rodney, in fact, Rodney, I think I've met you before. Your accountant set up a family trust when you started your business and did not assign an appointer. Is this a problem? Look, typically it'll have an appointer by another name. So I would say if your accountant has set up a family trust, I'd let a lawyer look at it if they've got if you know one, or if particularly you'd like to come through Lawpath, Rodney. Get them to look at it, but it's probably going to be okay. You'll probably have the role of the appointer perhaps carried out by someone else. Typically, when accountants set up family trusts, they're not trying to reinvent the wheel. They'll typically find a template that will have the guts of it right. Thank you, Rodney. And how does company director liability apply in trusts? Well, yeah, you'll typically be a director of the corporate trustee. So you do have obligations on you to act in good faith, to act without conflict, without profit, for the best interests of the beneficiaries. So you'll have liability if you don't do that. You'll be failing in your director's duties, and you'll be failing under trust law as well for exactly the same reason. So the company director of a corporate trustee does have liabilities, like you'd imagine, but typically they have separated themselves from the assets, so they should be okay. And I think we'll move on. How can Lawpath help? The Lawpath platform, for anyone that uses it, is designed for self-service for as much as you can do yourself. For anything that can be done on your own, we recommend that you do it. Save your costs for where you can really get bang for your buck. You can run your contracts through it. There are personalized workflows, e-signatures, things like that. You can easily book in time with lawyers for when you do need help. So the Lawpath platform itself is a huge resource, and we'll come to some of the elements that are included within that resource soon. Connor,
Yes, it's very much a best of both worlds of Lawpath. Like we can do a lot of the hands-on work for people. We're very much a one-stop shop. But the beauty of the technology and the online platform is that you can actually do a lot of this work yourself, and that really factors into why we're so low cost compared to like the traditional legal or accounting system. As you can see here, we do supply your business with unlimited legal documentation with over 500 templates, all professionally drafted by commercial lawyers, and they can generally be completed within 5 to 20 minutes, after which most people then actually book in an on-call contract review to go through the sort of nuts and bolts and the finer details of their document. So like our most basic essential subscription, which is just documents, for example, about 30% of the users on that are like a mix of lawyers or accountants. And then around the 3 to 6 month mark, people tend to upgrade to the legal advice plan. So that's for documents like trust-related documents, which I'll showcase now, including the discretionary trust deed, accounting documents, employment contracts. We pretty much have it all. These documents are actually built out as you go, depending on what you add in the contract builder. So some of the clauses can change as you go through step by step. But we've also got some very handy AI tools, including an ask feature, draft, review, simplify, and translate. And as mentioned, we have a legal advice plan there as well. So that's everything in the essentials, but now you have the added benefit of unlimited 30-minute consultations with our legal team. And we have an accounting advice plan as well, which is the same concept, unlimited consultations with our accountants. So most people on those advice plans, they're typically getting advice around tax minimization, tax concessions, the trusts, their business structuring or restructuring advice, different types of tax like GST, PAYG, crypto, their super reporting payroll, a whole host of tax and accounting related questions. And as I mentioned at the start, this will go out by email as well with a link to the webinar episode, as well as the slides and some other useful content. So just advise everyone, maybe depending on the email you're using, do check your spam folder because there will be a number of attachments and links in the email. So do check it. Sometimes it will go to spam when that is the case. But you can today, as we round off the quarter and this month, we're offering last chance to grab 30% off on our tax plan. And what you can expect with that is a dedicated tax agent. You get an initial tax consultation. It's your annual or quarterly BAS statements, your annual financial statements, your annual business tax return, and you also get a special fiscal year-end consultation with that as well. So it's all very much an A to Z service. You see we have some different bundle options here. There's over about 9 of them, I believe, but specific to today's topic, like we have an essentials and tax you could bundle together, and accounting and tax you could bundle together, and these actually carry a 40% discount automatically on them. So we do have the standalone advice and hands-on work, but you can bundle things together as well. So on the topic of the tax plan as well, maybe for you, Tim, like with the ongoing tax reporting requirements for a trust, like how can we assist people or make sure they stay compliant year after year?
Yeah, once you appoint us as your tax agent, it's really handled by ourselves. We know from the start of the year exactly what's due when. We keep you abreast of that. You'll have a dedicated tax agent. You'll have someone that's your client manager that knows everything about your business and knows what to expect. So we'll help you work. When we meet with you, we'll discuss what your obligations will be. Now, that can be easier said than done. Lots of companies and trusts have different sort of reporting requirements, but we can work you through it. We'll, of course, when we're your agent, we have access to everything the ATO knows about you. So we'll help you work out what's overdue. If you have any payment plans, if there's been any documentation sent by the ATO that perhaps you've missed because you haven't updated your address, we can help you with all of those things. Now, our bread and butter is, of course, the annual or quarterly BAS, the business activity statement, and then doing your year-end compliance work, your financial statements, your tax returns, a lot of the minutes and things, resolutions that help you run that, certainly the distribution minutes. We basically keep that all in hand. It becomes our responsibility. And as part of that year-end consultation, that's when we talk to you before June and we work out who's going to get the trust distribution.
If that is of interest to anyone, please just type yes in the chat and someone can reach out to discuss further or even actually run a platform demo for you as well. So you can actually see it from our existing subscribers' perspective. Or you'll see our contact details earlier posted in the chat, and my email is there and our LinkedIn is there as well.